now we're
This is the
still
first time we've done it.
working out these. This is something new. So before we go, I'd just like to introduce Shannon. Shannon Antonini is a crop insurance advisor at American Agcredit. She's responsible for developing and servicing crop insurance plans for ag producers throughout California, the western slope of Colorado, Hawaii, Oregon, and Washington. She specializes in wine grapes and tree fruit. She has served with American Agcredit for the last 8 years and has been a crop insurance agent since 2000. So Shannon, take it away, please.
Thank you. I'm going to go ahead and bring up my screen. Did that pop up for everyone?
Yes.
Yeah, okay. Great. Well, as John said, my name's Shannon Antonini, and thank you very much for having me tonight. We're going to talk about whole farm revenue protection. We're going to talk about what whole farm is, how it works, the features and benefits, and how you qualify for the coverage. Whole farm revenue protection is a safety net for all of the commodities that you're growing on the farm. It's under one policy. It kind of works like an umbrella policy. Then it covers all the revenue that you're reporting. It provides against losses to that revenue, but it does not cover uninsured causes of loss. So it's only available for natural causes of loss, similar to what the MPCI policy covers. It's based on your 5-year average revenue from your Schedule F income. So we take a look at those past 5 years and calculate an average, and it's either that or your current farm operation report, which would be for your current crop year. There's always a lag year with whole farm. So for 2021 coverage, we're looking at 2015 through 2019 Schedule F income. We do a simple average. If your operation has expanded, there is a function where we can insure higher than what that average shows based on that expanded operation. And we can also index that average. And those are different tools that we have to get you the highest average revenue possible. Your coverage is your revenue multiplied by the coverage level that you select. The coverage ranges from 50 up to 85%. We'll get into that a little bit more. You have to have at least 3 different commodities in order to guarantee coverage above 75%. So that 80 and 85%, you have to have 3. And those each one has to be a percentage above a certain percent of your total income, depending on how many commodities you do have. So diversification will actually lower your premium and increase the subsidies that you qualify for with whole farm. We also look at your expenses, your average expenses from your Schedule F. And if your expenses are less than 70% in a loss year, then it can reduce the amount of your claim. It doesn't cover any custom farming that you might do, any ag tourism. If you have crop insurance losses on your MPCI policy, that is not included in your revenue. And basically anything that doesn't come from the actual farming. There are a few limits with whole farm. Livestock has a limit of $2 million in the insurance year, and nursery has a limit of $2 million. The maximum revenue that you can insure or guarantee is $8.5 million. So the whole farm revenue, it protects revenue for crops where you don't have insurance. There's not a traditional MPCI policy available for those crops. It does work in conjunction with an MPCI policy. If there is a policy available, you actually receive some premium credits for carrying that MPCI policy also. Some of the advantages to whole farm is it's using your expected prices, not just a average price for your area or a regional price. It's a covering your actual revenue. Shoot, I just lost my train of thought. I was going to say something else about that. Again, we look at the 5 years of Schedule F income from your tax returns. For 2021, it's that 2015 through 2019. We also do a farm operation report or operating plan where we take into account what you're farming in that calendar year, what your expected yields are, and what your expected prices are. And it's the lower of those two that your guarantee is based off of. And again, my contact information, I know that was super brief and quick. Whole Farm has, like I said, it works like an umbrella over everything. So if you're growing coffee and you have some, lychee or avocados or some citrus or something else that you're also selling, it would cover all of those products under one insurance guarantee. Some differences between the MPCI and the Whole Farm also is that your MPCI, you're paid out at the time of your losses. With the Whole Farm, because your coverage is based on your tax returns, you're not actually paid out until after your tax returns have been filed for that crop year. And the coverage is, your insurance is based on how you file your taxes. So if you're a calendar year filer, it follows the calendar year. If you're a fiscal year filer, then it would follow your fiscal year. And that's where your coverage would be. Do you have any questions for me about Whole Farm?
One thing I found interesting is you can have whole farm insurance in addition to, like if I have crop insurance through Bonnie Lind, I can also get insurance for whole farm. Is that correct?
That's correct.
Okay. And I thought it was interesting that the different crops, and the reason is for the different crops, I guess it's cheaper because you have less risk of losing it all. If, for instance, if one crop is affected, the other ones aren't necessarily affected. Is that correct?
That's correct. So that's why the more diversified you are, the premiums do decrease because we're guaranteeing all of the revenue that you have coming in.
It's just based on, like you said, the taxes and your Schedule F. So
exactly.
Okay.
Well, if there aren't any questions, I'll stay on till the end. If you think of anything as the other Bonnie talks through the other policy, I'm happy to answer any questions at the end as well.
This is Stuart. You had mentioned that this is for the revenue. I know a lot of the operators there also sell things all the way up through retail. How does that work?
It doesn't cover any post-harvest production costs. So it doesn't, like if you are with coffee, if you are going to take it all the way to where you've roasted it and you're selling, it doesn't cover the difference between what the crop is worth at harvest time, because it's just covering that crop itself, the revenue from the crop. Does that make sense?
No, thanks.
I see it makes sense, but if you get all your coffee roasted, for instance, then, and it's part of the farm expense and you get it all roasted and you sell it all as roasted, then, and if you have a loss of your crop, does it go back? You have set fees like what the crop value is worth to that, or is it just uninsurable?
Well, it's looking at the revenue that was generated in that year from the crop. So
if you kept your own coffee and pulped it and dry milled it and did it all yourself and you sold it all as roasted, then that you couldn't insure that then, correct?
I would have, because that's I don't have any coffee growers honestly buying the Whole Farm right now. And so I would have to look into that a little bit further, and I'm be happy to do that and get an answer back to you on how that would affect the policy itself.
Andrea, do you still have a question? I saw your hand go up.
I guess Shannon kind of answered that she was going to look into it. Yeah, because otherwise what I was hearing her saying earlier was only cherry would be covered under the whole farm, and not parchment green or roasted, if that's what the farmer was doing. But yeah, Shannon, if you can please double check on that, so we know exactly what whole farm covers, if it's only cherry or if it also covers processed coffee as well as roasted.
Absolutely. I'd be happy to check into that and get it. I can send it back to John and he can post it as a comment or something attached to the.
I have had that inquiry before, and I've been told, and I've written the whole farm just to include what the pricing would be of the coffee cherry as it's delivered as cherry. No post-production value added is covered. And I've gotten that clarification from a couple of companies, but I've never seen anything be excluded out of that. So I've always stopped the value of coffee at the cherry point. So at the point that it's harvested, before it's milled, even if they do their own milling, we basically use a cherry per pound price when we're projecting, and they have to use the lesser of the two. So, and I've seen them sell roasted beans and have to back the pricing or value up to the cherry point. So if that makes sense.
And,
Yes, thank you, Bonnie.
okay.
But the rules change every year. So always check, because sometimes the rules change, and I ask that question every year to find out. So to verify that we're still stopping it at that point.
Hi, I'm in my second year of farm ownership, just a really small farm. But because I don't have 5 years of history, where would that leave me insurance-wise?
So with whole farm, and that was actually something they changed just in the last couple of years, you can, as a beginning farmer, we can use 3 years of Schedule F income, but you would have to have at least 3 years unless they're changing something. And I honestly, like Bonnie said, they do change all the time, and I have not seen the 2021 provisions yet. They're just coming out. But it would be 3, as of right now, it's 3 years of Schedule F that you need in order to set up a policy. There is also beginning farmer discounts and veteran farmer discounts for whole farm that are good for your first 10 years of farming, but it's only on whole farm that you get 10 years. On the regular MPCI policy, it's a 5-year benefit.
Now, if there's not any more questions, we'll get on to Bonnie. Let me introduce Bonnie. Thank you very much, Shannon. Appreciate it. That was informative, and I'm going to be giving you a call anyway to check on some of those things.
Okay, absolutely. Thanks for having me.
Okay. Bonnie began her 35-year career in the crop insurance industry when it was still an experimental USDA program. Early in her career, she worked for the USDA's Federal Crop Insurance Corporation in many capacities, including underwriting and loss adjustment. She started her agency in the late 90s and began writing insurance for Hawaii growers in 1998. So she's based in Clovis, California. She comes out to Hawaii several times a year to meet with new and existing clients, enjoys spending her time with her family, gardening, hiking, drinking coffee, painting, making jewelry, and half marathoning. So
Yeah,
welcome, Bonnie. Good to see you again. And
thank you,
it's all yours.
John. Thank you very much for inviting me to talk about crop insurance. As John said, I've been writing crop insurance in Hawaii for a few years, and I'm going to talk today about the coffee-specific programs. They are also eligible to be written under the whole farm that Shannon introduced and spoke about, and they can be written as a standalone alongside whole farm. I think it's always worth looking into whole farm if you're a coffee grower, just to check it out and see if there's a benefit there that may not be covered under the regular named multi-peril policy of coffee insurance or coffee tree insurance. covered under the Hawaii tropical fruit and Hawaii tropical tree policies. And I'm going to go through some slides pretty quickly, just in the interest of time, and stop me if I go too fast. But these are USDA programs. I always try to say that because one grower one time thought I was writing these policies myself out of my own office and paying claims out of my own office. I don't want anybody to think that's what's happening. These are all USDA developed, subsidized, and backed programs. And this information that I'm going to present is going to be very brief, so don't think that it's all the information that you need to know. I'd like you, can everybody see the slides right now?
No,
Okay. You can't see slides?
I don't see them. I think you have to share your screen down at the bottom.
I see it.
I have
Copy.
shared it, so.
Oh.
I see it.
I can see
Oh,
them.
maybe it's
Okay.
covered up. Never mind. I might have covered it up. Let's see. Hunting. Oh, there it is. I found it. Sorry. It got covered by another window.
Okay. So we refer to these programs as coffee and coffee tree coverage, but they are covered under the Hawaii tropical fruit provisions, which are cover 3 different crops, but that's the one that covers the coffee cherry, and the Hawaii tropical tree provisions, which covers the coffee trees. The tropical fruit provisions cover or provide coverage that's based on an actual production history. And the tree provisions are based on a coverage level multiplied by a tree count and insurance price. So that we actually develop a dollar guarantee on the tree policy. So we're going to cover the cherry portion of the policies first. The covered perils on most crop insurance policies look like this and include adverse weather, insects and disease that you can't control and you've tried. Fire, earthquake, tsunami, volcanic eruption, and wildlife, unless you haven't been able or you haven't tried to control the wildlife. Fire, also, you have to be able to prove that you're keeping underbrush or undergrowth and debris removed from your orchard. And there's a couple of others here on cherry crop insurance. If you do irrigate and you lose your irrigation water supply due to one of those previous causes, you're covered. And then here's a weird one, loss of cherry on trees. And this is specific to the Hawaii tropical fruit policy. Loss of cherry on trees that have been affected with a disease whose destruction is authorized by us. What's weird is that there's no bookended provision on the tree side to cover the trees in this case. But if you lose cherry and you've destroyed your trees or decided to destroy your trees to control the spread of disease, and us being the company, the claims division, has inspected and they have done everything they need to do, then you can claim the loss of cherry on those trees. There's no coverage against the damage or loss due to the inability to market for any cause other than those causes that we listed above. So quarantine's not covered. Coffee trees have to reach age 3, which means they have to be greater than 24 months old on December 31st prior to the attachment date of January 1st. The guarantees that we provide under the policy, it's a production guarantee based on your approved yield in cherry pounds, and that could be your actual average production, or it could be a risk management agency transitional yield. They provide us for crop insurance approved yields. Could be a combination of those two, or it could also be adjusted if the farm is downward or upward trending. And here's an example of an approved yield and kind of what our reporting looks like. We use a database of 4 to 10 years to develop your approved yield. And so this one shows a very simple one of 3 actuals and 1 transitional yield to come up with an approved yield of 4,906 pounds. And so we can start out with a 4-year base, and then once we start out, we build up to 10. Grower chooses 50 to 75% of the approved yield in the way of a guarantee. And you can actually choose a portion of the price in this program of the established price. I've never seen a grower take less than the established price of $2. This year it's $2 and almost 6 cents per cherry pound, unless you're organic, and then it's $2.67. The catastrophic coverage level is a 50% coverage production guarantee with a 55% price factor. So here's this little grid here just shows an example based on that 4,906 pounds approved yield, what it would cost per acre. This is just a real simple example. This column that has it is the subsidized premiums. The unsubsidized premiums are shown in the far right, but most growers qualify for subsidized premiums, and we'll talk a little bit more about that. There is an added admin fee per year for every policy, and it's for a catastrophic coverage level, it's $655, which doesn't make sense for any grower to participate in. If they're a 5-acre grower, their premium will be less than that. So the admin fee for a buy-up policy or higher is $30. So here's, again, restating the admin fees that are added. The costs are subsidized by the USDA. And here's how you qualify for USDA subsidized. You have to have a highly erodible wetland conservation compliance certification on file at the Farm Service Agency by the billing date next year. And you can contact Farm Service Agency, or you can contact NRCS for more information, or your agent. I mean, I can give information about that also. The tree provisions are next. Same list of insured causes pretty much, except we don't have the ones that apply to the loss of production. It's a tree-based dollar guarantee based on tree age, tree count, and the percentage of coverage level and the insurance pricing. Growers can choose 50 to 100% coverage with 55% of the, actually it's 50 to 100%. That used to have a price in there. So that growers choose 50 to 75% coverage. So I need to correct that before it gets shared, with an established price of 55% available for catastrophic coverage. So basically your coverage options are 27.5% of the insurance value of the trees for the catastrophic coverage level, or 50 to 75% for the buy-up levels. Trees have to just be planted by December 31st prior to the attachment date of January 1st. So you really don't have to have trees with a lot of age on them to get insurance on them. They just have to be planted before the December 31st deadline. You have to have a favorable company inspection. The company will inspect the trees and make sure that they are healthy, good farming practices are being followed, and that they are disease-free. And then one more unique provision for coffee tree growers who want to get insurance is they have to provide evidence of at least 4 consecutive years of experience growing the crop, excluding the year the trees were planted. So that's just about 5 years of experience. Growers who are mentored can sometimes talk to their company or their agent about meeting that requirement. If they're just beginning, they would have to have a mentor who's pretty hands-on. And that's not listed in the provisions. It's just something that I've found through making inquiries for growers who didn't meet the 5-year or 4+ years requirement. And then there's some pretty interesting options on the Hawaii tropical tree coverage for coffee tree crop insurance. The first one is the occurrence loss option. And what it does is it changes the loss trigger and just about has the effect of removing the deductible up front, and it begins paying once 3% of your trees are lost. It applies the deductible on a per tree basis once that loss trigger is activated. And then there's another option called the comprehensive tree value, and it provides and pays an additional benefit. It's 50% payable at the time the land has been cleared and the soil treatment has been completed. And it's the second half is payable at the time that the land has been replanted to coffee or another tropical tree crop or a perennial crop. And the replant must occur within 2 years to receive that second half of that benefit. This is an example of, this is a premium example of these 3 types of policies. The first column shows the coverage level, so it shows the price selection. In the second column, the basic coverage that we spoke about is listed here, and this is based on 500 trees that are age 4 or older, so mature trees. So the premium can go from $14 for 500 trees up to $37. Subsidized with occurrence loss option, just about triples those numbers all the way down, a little bit more than that in some cases. So anywhere from $48 to $99 for that same 500 trees, to include the option that removes the deductible from the upfront portion of the claim determination. And then if you add all the options, including that comprehensive tree value, the premiums increase pretty dramatically from $108 to $222 for that 500 trees. And this is just an example. You should get a quote from your agent that's particular for your farm. General information on claims. On any crop insurance policy, no matter what type of coverage you have, keep in mind that losses and loss time limits, and you need to report any possible damage immediately when an event occurs, or if you notice damage. I just got a screen that says my internet is intermittent right now, so if I space out, that's why. Provisions include many details, so please review your loss requirements with your agent. And this is just a statement about who does the claims. The loss adjusters that are hired by the companies that have appointed Shannon and I handle the claims. There's a whole claims department set up, and we are prohibited from participating in that process. And any claims related to any questions related to claims should be directed to the claims loss adjuster. I put the slide in one time when growers were trying to get me to participate in meetings related to how claims were prepared, and I don't want to be part of that process because the companies don't want us to be part of that process, because the USDA wants there to be a division between us and the claims division. So here's a area policy. This is based on a 1-acre farm with a 5,000 pound approved yield, selecting the 75% coverage level. So under that computation, the grower would have 3,750 pounds guaranteed on that 1 acre. And if that grower produced 1,000 pounds of cherry in a particular year, it would be calculated to a 2,750 pound loss. And this is an old price selection, $1.66. I guess I didn't update that slide, so another one I need to fix. And it shows the indemnity in this case being $4,565. So it's right around $2 now. So that would be well over $5,000 for that same loss this year. This is a tree example. And this is based on 500 trees at the stage 4 price of $43.25. And so it shows the insurance value of $21,625. If in this example, 300 trees were dead, we would compute the value of those dead trees at the same price election for a computation of $12,975 being the value of dead trees. We'll divide that by the value of the insured trees, and the percentage of damage is 60%. So from that 60% of damage, we would subtract the deductible. For 75%, it's 1 minus 75. So the deductible is 25. And that removed from the 60% damage gives us a payable loss of 35%. We multiply that times the value of insured trees for an indemnity of $7,219. Here's an occurrence loss option example. The same example would pay, if you look at the bottom line down here, and there's a whole lot less lines to compute because we aren't worried about computing the deductible on an upfront basis. We basically start paying on tree number 1 once the loss exceeds 3%. And then we apply the price, the coverage level election times the value of dead trees to come up with the loss payable. So you can see this compares to that example that I just gave where $7,219 was the loss payable. And now with the occurrence loss option, same amount of coverage under the policy, but the grower is going to receive $9,731. I highly recommend everybody look at this option. Here's another example. Have met the deductible on a traditional policy without the option, and it shows that the amount payable is $3,244. And again, 20% loss wouldn't have met the deductible on the 75% coverage level without the option. And so this shows the occurrence loss option actually benefiting growers at a rate that's higher as far as meeting deductibles. The deductibles are pretty difficult. The trees have to meet a definition of dead. So under this condition, the grower would have to have lost 25% of his trees in this example. And he didn't. So he still gets paid with this option added. Again, the premium is about triple what it is, the basic coverage, and in some cases a little bit higher. There's a hurricane insurance protection wind index policy available, or it's an endorsement available on coffee and coffee tree insurance. And what it does is it covers 1 to 95% of your deductible on your underlying crop policy. You choose which percentage coverage. It's fairly inexpensive. The full value is paid if your county is within the area of sustained hurricane force winds from a named hurricane based on data published by NOAA, National Hurricane Center. And you have to apply for that, and you have to pay an additional administrative fee. Take a look at it because you can pretty much pick whatever premium you want to pay on it, since there's a 1% to 95% coverage amount that you can choose. So just to summarize, there's 2 kinds of policies to look at for coffee specifically, and it's cherry and tree. The options on the tree coverage include the occurrence loss option, comprehensive tree value, and one or both may be added. And I didn't include any examples of the CTV, but you can check with your agent about that. Consider hurricane insurance protection of the deductible. It basically pays out whether you have damage or not, as long as the hurricane is registered in your county. And check with FSA about conservation certification to qualify for all these subsidized premiums, keeping your costs down. The deadline to apply for the 2021 crop year is December 31st. And you want to try to get your application into your agent as soon as you can, because there's a 30-day received after December 2. You can apply through an agent certified through the USDA's risk management agency and appointed by an approved insurance provider. You can find an agent. If you don't know one, you could find an agent. And Shannon and I are here. We both are very interested in helping growers get covered. But if you don't want to work with either one of us, you can go try to navigate that government website that shows you other agent options. We're all subject to the equal opportunity statements through the USDA. We can't discriminate. I think we should have farm size on here also, because I don't discriminate against small farms, and there's a lot of them in Hawaii, and it really is a question that I've had before. You can have less than 1 acre and still get insurance. And this is my contact information. Again, my insurance agency name is Lind Insurance Services, and I appreciate your time tonight. Thank you. Do you have any questions?
We have a question from Jim Monk down here, who
Hi,
should
Jim.
unmute himself and ask your question.
see. I'm going to try to.
I didn't know I could unmute myself. I thought only you could do that. Bonnie, thank you for the presentation. I have a question. Do we need to tell you or our agent, pardon me, as soon as we might discover coffee leaf rust in our fields, or do we wait till it's a total disaster to let you know?
I think I wouldn't wait. I would call your agent immediately, and that way we actually get a notice of claim filed on your behalf within the time limits. So if you wait and decide, I'll just wait until we see if it's going to be a disaster, and then you exceed a time limit for a claim, you might be disqualifying yourself from a claim payment just based on time limits. So like I put in that one slide, don't wait. Anytime or an occurrence happens that may cause damage, even if you're not sure of the extent, call your agent. I would call your agent.
Okay, thank you.
You're welcome.
Okay, just
Good question. And a lot of people think
go ahead.
a lot of people think they need to know what their cherry harvest is before they report damage. And I encourage growers, even if you're not sure and you just think it's light, possibly, to definitely call your agent.
We have Andrea's raised her hand. Just unmute yourself and
Hey, Bonnie.
Hi, Andrea.
Hi. So if a grower has coffee root knot nematode, are their trees insurable?
I believe that they are supposed to be free of the nematode at inspection time in order to get coverage for that specific cause of loss. I haven't seen anybody ever turn down for insurance, but if they mention it during an inspection, it's possible that the disclosure of that would cause some questions to be raised. So I should probably give you a better answer on that, but I'm pretty sure that our provisions say that they're supposed to be free of nematodes. So let me double check on that and get back to you.
Thank you.
Thanks for the question. It's always good to brush up on that stuff.
And I have a question. The insurance, the company comes out and inspects the trees. Is that true?
Yes. For new applications, they generally inspect, they're not required to, but they generally do inspect all new policies. And I think they're going to be inspecting all the coffee tree applications, all those farms that come in on coffee tree applications this year.
I have another question if there's nobody else. CTV, that coverage, it appeared from what I saw on the screen that it only applies for a total loss. Is that correct?
No, the CTV is just an additional payment that works along with your existing coverage. And so if you've met your deductible, then it also will kick in and pay an additional amount equal to the percentage paid under your existing coverage. So it's like an additional lump sum. It was explained to me when I first saw this program come out that it's like a business interruption additional payment because your trees are out of commission for a few years. So if you're getting paid 10% under your basic policy, then you're going to get paid the CTV payment, which is an additional, just an additional separate amount that's computed based on your tree count, tree age, and the price listed in our rates and rules for that purpose. And it's actually higher than the tree price selection. I should have included the example, but it does get pretty pricey, but I think it's worth looking at. If you have the occurrence loss option, once you lose all those, and you also have the CTV, it also kicks in and starts paying once that loss, once the tree loss exceeds 3%. Okay. And it's not subject to a deductible at that point until it's a per tree pricing that you're looking at. Then the deductible is applied per tree.
I see Jim's raised his hand. Jim Monk.
And just full disclosure, Bonnie is my agent, but I just want to say that every year I have had someone come to visit me after I've had my harvest, and they have wanted copies of every one of my pick records. But once I've gone through that and they've gone out and inspected the field, then I have received a payment if my yield did not come up to the guaranteed. And so it is a program that works very well for me, or has worked very well for me. And so I recommend it.
Thank you, Jim. And what Jim mentioned, the requirement for records, it just depends on if you deliver to a third-party processor or not. And if you don't, and you're handling your own processing, then pick records are a substitute for the records from a third-party grower. There's a lot of different types of records that can qualify you if you're a vertically integrated producer, which there seem to be a lot of in Hawaii that do their own processing. So in some cases, the record keeping is a little more tedious than it would be as if you were delivering your crop to a processor. But Jim's been successful in collecting for claims because he keeps good records, and that's part of what you need to do.
I believe that, Jim.
That's part of his job. Any other questions out there? Well, then I think we can wrap it up. I want to thank you both, Shannon and Bonnie, for the presentation. Just want to let everybody know that this has been recorded. Is on the KCFA or will be on the KCFA web in the future here. So one of them or another agent, if you prefer, and see if they can help you at all. So anyway, on behalf of the KCFA, thank you all for attending. And Bonnie, thank you very much.
Thank you,
and
John.
Shannon, thank you. And we'll talk to the rest of you later. Thanks again for being here.
Thank you.
Have a good afternoon. Thank you.